am Dr. Neha Seth, working in the capacity of Associate Professor at Symbiosis Institute of Business Management, Noida, a constituent of Symbiosis International Deemed University, Pune. Welcome back to the second session on Indian financial systems. So, Indian financial system has four strong pillars. The first pillar is financial institutions and intermediaries. These financial institutions and intermediaries are classified into two parts, that may be banking institutions and non-banking financial institutions. The second pillar of Indian financial system is financial instruments. These are primary instruments, secondary instruments, and there are risk management instruments, also known as derivative instruments. The third pillar is financial markets. Financial markets are categorized into money market and capital market. Money market is a short-term market, or I can say it is a market where the financial instruments that are traded for less than 1 year are there. Then capital market is a long-term market. So, all those financial assets that are traded for more than 1 year are being traded at capital markets. These capital markets are further classified into primary market and secondary market. So, when a new financial asset that is coming into the market, it is introduced for the first time in primary market, and when it is traded further into the market, it is traded in secondary market. The fourth and important pillar is financial services. These services are further classified into fee-based services and fund-based services. Now, let us see these pillars one by one in detail. The first pillar of Indian financial system is financial institutions. So, financial institutions are like a backbone for Indian financial system. What are banking institutions? So, these are the institutions mobilize the savings of people. They extend credit while lending money. They provide a mechanism for the smooth exchange of goods and services. They serve as a platform between lenders and borrowers. They are the bridge between the savings and the capital requirements. There are three basic categories of banking institutions. These are commercial banks, cooperative banks, and developmental banks. Commercial banks in India carry more than 2/3 of assets of all financial institutions. Commercial banking can be further divided into four parts. These are public sector banks, private sector banks, foreign banks, and regional rural banks. Now, for quoting an example, for public sector banks, we have banks like State Bank of India, Punjab National Bank. These are the examples of public sector banks which are operational in our country. When I talk about private sector banks, there are banks like ICICI, Axis Bank. These are the examples of private sector banks in India. HSBC, Standard Chartered, Deutsche Bank. These are the examples of foreign banks which are operational from our country. And the fourth category is regional rural banks. These are the Gramin banks which are working or operational from a very small area in our nations. These are there to cater the needs of rural areas like Gramin Bank. Then we have another category of financial institutions. These are non-banking institutions. Non-banking financial institutions also mobilize financial resources directly or indirectly from people. They lend funds but do not create credit. Companies such as Life Insurance Corporation, General Insurance Corporation, UTI, Development Financial Institutions, Organization of Pension and Provident Funds, they all fall into this category. Non-banking financial institution can be categorized as investment companies, housing companies, leasing companies, hire purchase companies, specialized financial institutions like Exim Bank, investment institutions, state level institutions, etc. Some examples of non-banking financial institutions can be General Insurance Company, Export-Import Bank of India, National Bank for Agriculture and Rural Development, that is NABARD, NHB, that is National Housing Bank, TFCI, that is Tourism Finance Corporation of India. These all are examples of non-banking financial institutions in India. The second one is financial instruments. Now, what are financial instruments? The financial instruments represent a claim against the future income and the wealth of investors. It will be a claim against a person or an institution for the payment of money at a specified future date. There are three broad categories of financial instruments. These are primary instruments, we call them primary securities, or direct instruments as well. Secondary instruments, we call them indirect instruments or secondary securities. And then there is a third category which is known as derivatives. These are also known as risk management instruments. When I say primary or direct instruments, so these instruments are issued directly by the borrowers to the lenders. The examples of direct instruments can be equity shares, preference shares, debentures. And when I say secondary or indirect instruments, these are the instruments which are issued by financial intermediary to an ultimate lender. The example of indirect securities can be mutual fund units. The third important pillar of Indian financial system is financial market. So, what is a financial market? Just like a physical market where we go out and purchase any commodity of our need, and in return of that we pay money. Similarly, financial market is also a place. It is a place where financial assets are created and traded. So, if we want to invest our money in any of the financial asset, we will be dealing in financial markets. There are two components of financial markets. These two components are money market and capital market. Now, what is money market? This is a market for borrowing and lending of short-term funds. It is a mechanism through which short-term funds are borrowed and through which a large part of financial transactions of the world or a country is carried out. There are examples of money market instruments. For example, we have certificate of deposits. Certificate of deposits are nothing but the fixed deposits that where we are putting our money, we are going to the bank and we are putting our money for a specific period of time. When we are putting our money for less than 1 year, that means we are dealing in a money market instrument, which is a certificate of deposit. Then we have another example of money market instrument, that is commercial papers. These are issued by big corporate houses when they want to invite money from general public. We have treasury bills. These bills are issued by government. These are the examples of money market instruments. The next we have is capital market. This is the market for financial assets which have a long-term maturity. The capital market deals with long-term securities with a maturity period of above 1 year. The capital market can further be classified into two parts, or it may have two further components. These are primary market and secondary market. Now, what do I mean by primary market? This is a market for a new issue or a new claim. Therefore, it is also known as a new issue market. So, when a company is issuing its share for the first time, which is also known as IPO, initial public offering, So when the initial public offering is made to general public for the first time, when the company is coming to the market for the first time, we are dealing in primary market in that case. And once this IPO is launched, the further trading of the same share is happening amongst the investors. One person is buying, another is selling. Now this buying and selling that is happening after the introduction of IPO into the primary market, this dealing is happening in secondary market. So the market in which securities are traded after they are initially offered in the primary market is known as secondary market. The fourth pillar of Indian financial system is financial services. The objective of financial service sector is to intermediate and facilitate the financial transactions of individual and institutional investors. The financial service industry can be classified into two broad categories. These categories are fee-based financial services and fund-based financial services. So when I say fee-based financial services, these are the services which are provided by financial institutions or non-banking financial institutions to earn income by the way of fee, commission, discount and brokerage. The major fee-based financial services can be issue management, merchant banking, corporate advisory services, credit rating. These are classified as fee-based services because whenever any banking or non-banking financial institution is providing this kind of service, they are charging fee against this service. That is why these kind of services are categorized as fee-based financial services. Then another category we have is fund-based financial service. When we say fund-based financial service, by this term we mean that the firm raises funds through equity, debt and deposits and invests the same in securities or lending purposes. The major fund-based services can be leasing services, hire purchase services, venture capital, mutual fund management. These are the examples of fund-based services. Why these are categorized as fund-based services? Because by providing these services, a banking or a non-banking financial institution is raising fund. So that is why these services are categorized as fund-based financial services. So these were the four important pillars of Indian financial system. But there is a shed which is covered or which is covering these pillars. This shed is regulatory framework of Indian financial system. There are four regulators of Indian financial system. These four financial regulators are Reserve Bank of India, we call it RBI. Then we have Securities and Exchange Board of India, we call it SEBI, SEBI. Then we have IRDA, which is known as Insurance Regulatory and Development Authority. Then we have PFRDA, that is Pension Fund Regulatory and Development Authority. Financial sector in India comprises commercial banks, insurance companies, non-banking financial companies, cooperatives, pension funds, mutual funds, and other smaller financial entities. That is why regulation and supervision of financial system in India is carried out by different regulatory authorities. By the name, it is clearly understood that Reserve Bank of India is there to take care of banking system in our country. Securities and Exchange Board of India is there to take care and to regulate the financial markets of our country. Insurance Regulatory and Development Authority is there to take care of insurance sector of our country. And then we have PFRDA, that is Pension Fund Regulatory and Development Authority. It is there to take care of retirement funds like pension fund of our country. The first one is Reserve Bank of India. Reserve Bank of India is also known as Central Bank of our country. This is the apex monetary institution of our India. We also call it Bank of Banks. So whenever banks need a banking service, they go to Reserve Bank of India. Reserve Bank of India regulates and supervises the major part of Indian financial system, that is the banking system. It plays supervisory role for commercial banks, urban cooperative banks, some financial institutions and non-banking financial institutions as well. Reserve Bank of India got its powers from the Banking Regulation Act 1949. This act has given RBI the power to regulate the banking system of India. The RBI was established on 1st April 1935 in accordance with the provision of Reserve Bank of India Act 1934. The central office of Reserve Bank of India was initially established in Kolkata, but it was permanently shifted to Mumbai in year 1937. There are numerous roles which are played by RBI as a regulator of Indian banking system. Few of its roles includes issue of license. So they issue license to banks for providing banking services. There are prudential norms which are being managed by RBI. Corporate governance norms. Now we have KYC norms under which they take care of customer. They have the transparency norms. They also play a major role in risk management. They can conduct audit and inspections. They also control foreign exchange of our country. So these were the roles which are played by RBI as a regulator of Indian banking system. The second regulator is Securities and Exchange Board of India. We call it SEBI as well. So the SEBI was first established in year 1988 as a non-statutory body for regulating the securities market. It became an autonomous body and acquired more powers in accordance with the provision of the SEBI Act 1992. The Securities and Exchange Board of India regulates the securities market to protect the interest of investors in the primary market as well as secondary market. It is there to protect investors' money. The board has powers to regulate functioning of stockbrokers, sub-brokers and other intermediaries as well. When I talk about the role of SEBI as a regulator of India, then I must mention that SEBI regulates the business of stock exchanges and any other security market. It registers the working of stockbrokers, sub-brokers, share transfer agents, bankers to an issue, trustees of trust deeds, registrars to an issue, merchant bankers, underwriters, portfolio managers, investment advisors, and other such intermediaries. SEBI also promotes self-regulatory organizations. SEBI prohibits fraudulent and unfair trade practices relating to security markets. It promotes investors' education and training of intermediaries of security markets. It prohibits insider trading in securities. SEBI calls information from undertakings, inspections, conducting inquiries and audits for stock exchanges, mutual funds, and other persons associated with securities markets. Now, let's move to the third regulator of our Indian financial system, that is IRDA, Insurance Regulatory and Development Authority. So, IRDA is an autonomous apex statutory body that regulates and develops the insurance industry in India. It is constituted by Parliament of India Act called Insurance Regulatory and Development Act 1999, or it is also known as IRDA Act 1999, and the act was duly passed by Government of India. The headquarters of IRDA, the agency that we call IRDA, operates from its headquarters in Hyderabad, Andhra Pradesh, but it was shifted to Delhi in year 2001. IRDA protects the interest of the policyholders. It also regulates, promotes and ensures orderly growth of insurance business and reinsurance businesses. IRDA issues certificates of registration, renewal, modification, etc., and also has the power to suspend or cancel such registrations if required. The last pillar of Indian financial system is Pension Fund Regulatory and Development Authority, that is PFRDA. So, PFRDA was established by Government of India on 23rd August 2003. PFRDA was authorized by Ministry of Finance, Department of Financial Services, and PFRDA promotes old age income security by establishing, developing and regulating pension funds and protects the interest of subscriber. So, these are the four important regulators of Indian financial system. These were Reserve Bank of India, Securities and Exchange Board of India, Insurance Regulatory and Development Authority, Pension Funds Regulatory and Development Authority of India. So, all these five major components comprises of Indian financial system. So, Indian financial system, to sum up, I would like to conclude that Indian financial system includes four major pillars that were financial institutions and intermediaries. Then we have financial instruments, we have financial markets and financial services. We have also seen the classification of these pillars. These pillars are supported and investors' funds are protected by various regulatory authorities which are there in India. We have discussed about four regulatory authorities or four important regulators which are operating in India. These are Reserve Bank of India, SEBI, IRDA, Pension Funds Regulatory and Development Authority. So, to conclude, the financial system in India is a dynamic ecosystem where different elements work together to drive economic growth. Whether you are depositing money in the bank, investing in stock market, or securing your future with insurance, you are an integral part of ecosystem. Financial literacy, which is very important. So, financial literacy empowers individuals to make informed decisions. It is not about just numbers. It is about empowering every individual to be informed and responsible participant in financial journey of our country.